Preparing for a Freddie Mac Finance Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a finance analyst at Freddie Mac? I am drawn to Freddie Mac because finance here supports both business performance and housing market stability. The finance analyst role fits my strengths in financial analysis, Excel, forecasting, and communicating insights clearly. I would enjoy working with large, complex datasets while understanding how interest rates, mortgage activity, credit performance, and funding costs affect results. Freddie Mac also offers a mission-driven environment where disciplined analysis can influence decisions benefiting borrowers, lenders, and the broader housing system. While answering, connect your analytical strengths to Freddie Mac's housing finance mission, explain interest in forecasting and reporting, and show awareness of the company's public purpose role, risk environment, and importance of accurate financial information. Question 2. Walk me through your background and explain how it prepared you for this role. My background combines accounting fundamentals, financial modeling, and practical data analysis. In my coursework and internship, I built spreadsheet models, reconciled financial information, and summarized monthly performance for non-technical audiences. One project required analyzing budget to actual variances and identifying the operational drivers behind them. That experience taught me to validate source data before drawing conclusions. I am now ready to apply those skills in a larger, more regulated organization where accuracy, judgment, and communication all matter. Make sure to cover relevant coursework, internships, systems experience, analytical projects, communication skills, and one measurable accomplishment. Organize your response around evidence that you can analyze data, meet deadlines, and explain conclusions to stakeholders. Question 3. What are the three primary financial statements, and how are they connected? The income statement shows revenue, expenses, and net income over a period. Net income flows into retained earnings on the balance sheet, while the balance sheet presents assets, liabilities, and equity at a point in time. The cash flow statement reconciles beginning and ending cash through operating, investing, and financing activities. For example, depreciation reduces income but not cash, so it is added back in operating cash flow. Together, the statements explain profitability, financial position, and liquidity. In your answer, define the income statement, balance sheet, and cash flow statement. Explain net income, retained earnings, working capital, and reconciliation, and demonstrate that you understand links rather than memorize labels. Question 4. How would you analyze a budget to actual variance? I would begin by calculating the variance in dollars and percentage terms, then assess whether it is material. Next, I would separate timing, volume, price, foreign exchange, and one-time effects, depending on the expense or revenue category. I would speak with the responsible business owner and test the explanation against invoices, forecasts, or operational data. Finally, I would update the outlook if the variance is recurring and document the root cause and recommended action. Be sure to mention materiality, favorable versus unfavorable direction, price-volume mix or timing drivers, owner discussions, supporting evidence, forecast implications, and clear documentation of root cause rather than simply reporting the numerical difference. Question 5. What financial metrics would you monitor at Freddie Mac? I would monitor metrics across profitability, risk, liquidity, and operating performance. Profitability measures could include net interest income, net interest margin, fee revenue, expenses, and earnings. Because Freddie Mac operates in housing finance, I would also watch mortgage purchase or guarantee volume, delinquency trends, credit losses, reserves, liquidity, and capital levels. I would interpret each metric with market context, especially interest rates, refinancing activity, home prices, and changes in mortgage credit performance. While answering, discuss metrics relevant to a housing finance enterprise, including net interest margin, investment income, credit losses, delinquency, liquidity, capital, expenses, profitability, and volume, while noting that interpretation depends on market conditions and accounting treatment. Question 6. How do changing interest rates affect Freddie Mac's financial performance? Interest rate changes affect both mortgage activity and the value of Freddie Mac's assets, liabilities, and derivatives. Higher rates can reduce refinancing and origination volume, increase funding costs, and create valuation changes depending on duration and hedge positions. Lower rates may support mortgage demand but increase prepayments and refinancing risk. I would analyze the sensitivity of net interest income, fair value movements, and capital, distinguishing temporary accounting effects from the underlying economic exposure. In your answer, cover mortgage demand, refinancing, funding costs, asset and liability duration, fair values, hedging, net interest income, and the difference between short-term accounting volatility and longer-term economic exposure. Question 7. Explain the difference between accrual accounting and cash accounting. Accrual accounting records revenue when it is earned and expenses when they are incurred, regardless of when cash changes hands. Cash accounting records activity only when payment or receipt occurs. For example, if Freddie Mac receives an invoice in December and pays it in January, accrual accounting recognizes the expense in December. That timing provides a better view of period performance and helps analysts distinguish operational results from temporary cash flow timing. Make sure to explain that accrual accounting records economic activity when earned or incurred, while cash accounting follows settlement. Use an expense or revenue example and connect the distinction to forecasting and management reporting. Question 8. What is a financial forecast, and how would you build one? A forecast is an estimate of future financial performance based on historical results, current data, and explicit business assumptions. I would start by validating the historical baseline, then identify drivers such as mortgage volume, rates, credit performance, headcount, funding costs, and expenses. I would build a base case with upside and downside scenarios, review assumptions with stakeholders, and compare actual results against forecast regularly. Significant variances would trigger assumption updates, not simply spreadsheet adjustments. Focus on historical trends, business drivers, assumptions, scenario analysis, monthly phasing, actual versus forecast monitoring, stakeholder validation, and model controls. Explain that a forecast should be dynamic and updated when evidence changes. Question 9. How would you ensure the accuracy of a financial model in Excel? I would separate inputs, calculations, and outputs, use consistent formulas, and label assumptions clearly. I would reconcile key totals to source systems or published reports, include balance and error checks, and test the model using independent calculations. I would also review unusual changes, assess sensitivities, and have another person inspect important formulas. Finally, I would control versions and document updates so users can understand what changed, why it changed, and which results are affected. Be sure to mention clean inputs, consistent formulas, checks, reconciliations, independent reasonableness tests, version control, locked cells, documented assumptions, peer review, and sensitivity analysis before distributing results. Question 10. Describe a time you found an error in financial data. During an internship, I noticed that a monthly expense report was materially higher than the prior trend. I traced the variance to a duplicated invoice created during a data upload. I compared the transaction listing with the source ledger, confirmed the issue with the accounting team, and corrected the report before distribution. I then added a duplicate check step to the process. The experience reinforced that unusual trends should be investigated before conclusions are communicated. In your answer, use a concise star structure, quantify the issue if possible, explain how you isolated the root cause, describe corrective and preventive actions, and emphasize professional escalation rather than assigning blame. Question 11. What is the purpose of a balance sheet reconciliation? A balance sheet reconciliation confirms that a general ledger balance is complete, accurate, and supported by underlying records. I would compare the ledger with a subledger, bank statement, schedule, or external confirmation, identify reconciling items, and investigate aged or unusual differences. Each item should have documented support, an owner, and a resolution timeline. Reconciliations are especially important in a regulated financial environment because they help prevent misstated reporting, control failures, and recurring operational errors. While answering, explain reconciliation as an independent completeness and accuracy check, covering ledger to subledger comparison, outstanding items, aging, supporting documentation, investigation, approvals, and timely resolution of breaks. Question 12. How would you explain a complex financial result to a non-finance stakeholder? I would start with the conclusion and business impact, then explain only the drivers necessary to support it. For example, instead of leading with accounting terminology, I might say that earnings declined because higher rates increased funding costs while mortgage volume fell. I would quantify the impact, distinguish recurring from temporary factors, use a simple chart if helpful, and finish with the forecast implication or decision required. I would invite questions and confirm the stakeholders' understanding. Make sure to cover audience awareness, leading with the conclusion, plain language, business drivers, visual support, quantified impact, recommended action, and checking understanding without overwhelming the listener with technical accounting terminology. Question 13. What is a key control, and why does it matter at Freddie Mac? A key control is a process designed to prevent or detect a significant error, omission, or unauthorized activity. A review of a financial report before release is a detective control, while system approval limits are preventive. Effective controls have clear ownership, appropriate frequency, documented evidence, and follow-up for exceptions. At Freddie Mac, strong controls matter because financial information supports management, investors, regulators, and housing market decisions. Reliable reporting depends on both sound processes and disciplined execution. In your answer, define a control that prevents or detects material error or misconduct, distinguish preventive and detective controls, discuss evidence and ownership, and connect strong controls to reliable reporting, regulatory confidence, and risk management. Question 14. What accounting challenges can arise from mortgage-related assets and guarantees? Mortgage-related accounting can involve significant judgment because values and cash flows depend on rates, prepayments, defaults, recoveries, and home prices. Analysts may need to consider expected credit losses, fair value changes, securitization structures, guarantee obligations, and derivative hedges. I would focus on understanding the applicable accounting guidance, validating model inputs, reviewing changes in assumptions, and reconciling reported movements to economic drivers. Strong documentation is essential because small assumption changes can materially affect results. Be sure to discuss valuation, expected credit losses, loan modifications, securitizations, guarantees, prepayments, derivatives, fair value judgments, model assumptions, and the need to understand both accounting guidance and economic substance. Question 15. How would you assess whether a forecast assumption is reasonable? I would compare the assumption with historical results, recent actual trends, management's operating plan, and credible external data. I would ask what changed from the previous forecast and whether the assumption is consistent with related drivers. For example, a higher mortgage volume forecast should align with rate, housing, and market share expectations. I would run sensitivities and downside cases, document the rationale, and escalate assumptions that lack support or create an unrealistic overall result. Focus on historical performance, external market data, operational plans, sensitivity analysis, comparisons with prior forecasts, management judgment, downside risks, and evidence that the assumption is internally consistent with other model inputs. Question 16. Tell me about a time you managed competing deadlines. During a semester-end project, I had a financial analysis due while completing an internship reporting cycle. I listed deliverables by deadline and consequence, completed the data-dependent work first, and asked my supervisor to confirm priorities. I created checkpoints for validation rather than leaving review until the end, then communicated progress and any risks early. Both assignments were delivered on time. The experience taught me that prioritization, transparency, and quality controls are more effective than simply working longer. Use STAR and show how you prioritized tasks by business impact and deadline, clarified expectations, communicated early, maintained quality checks, and delivered results. Include a specific example rather than describing generic time management habits. Question 17. What would you do if a senior stakeholder challenged your analysis? I would treat the challenge as an opportunity to test the analysis, not as a personal conflict. First, I would clarify which conclusion or assumption concerns the stakeholder. Then I would revisit source data, formulas, timing, and definitions, and compare the result with independent evidence. If I found an error, I would acknowledge and correct it promptly. If the analysis remained sound, I would explain the support clearly and discuss sensitivities or alternative scenarios. In your answer, demonstrate openness, calm fact-finding, source validation, clarification of assumptions, willingness to correct mistakes, respectful disagreement when supported, and focus on reaching an accurate decision rather than defending personal ownership. Question 18. How do you use data analytics or automation in finance? I use analytics to reduce manual work and improve consistency. For example, I have used Excel and SQL to combine transaction data, identify exceptions, and summarize trends by business segment. Before automating a recurring report, I would define the required output, validate the logic against a known period, and build control checks for missing or duplicate records. Automation can save time, but I would still review unusual results and ensure the process remains understandable and auditable. While answering, mention tools you genuinely know, such as Excel, SQL, Power BI, Python, or Alteryx. Explain the business problem, validation steps, control considerations, time saved, and why automation should improve judgment rather than replace it. Question 19. What risks would you consider when analyzing Freddie Mac's financial performance? I would consider interest rate and prepayment risk, borrower credit performance, liquidity and funding risk, market valuation changes, model risk, operational errors, cybersecurity, and regulatory developments. I would assess how each risk could affect earnings, capital, liquidity, or reporting reliability. Scenario analysis and sensitivity testing help quantify exposure, while controls and monitoring provide early warning. I would also distinguish direct financial effects from reputational or compliance consequences, since those can influence long-term business outcomes. In your answer, cover interest rate, credit, liquidity, market, operational, model, cybersecurity, regulatory, and reputational risks, and explain how scenario analysis, controls, monitoring, and escalation help convert risk awareness into sound financial decisions. Question 20. What questions would you ask the hiring manager about this finance analyst role? I would ask what the analyst should accomplish in the first 6 months and which reporting or forecasting processes require the most attention. I would also ask how the team partners with accounting, treasury, risk, and business units, which systems and analytical tools are most important, and how performance is measured. Finally, I would ask what distinguishes analysts who advance at Freddie Mac. Those questions would help me understand both immediate expectations and longer-term development. Be sure to ask targeted questions about first-year priorities, reporting cycles, stakeholders, systems, development, team culture, and measures of success. Avoid questions answered directly by the job description or public company website. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.